How investable are the Chinese markets to us here in the West? Welcome to today's IG Trading the Markets podcast. We're joined now by Brendan Ahern from Kraneshares. You can invest in Kraneshares and the indices on the IG platform. Brendan, welcome. We're looking at how transparent the Chinese markets are. You have been quoted as saying it's a veritable alphabet soup in terms of how you describe shares. There's A shares, there's B shares, there's H shares, there's domestic ownership, there's foreign ownership. You can invest in state companies, you can invest in private companies. How do you appraise the Chinese markets for us here in the West in a simplistic form of describing what we're being offered?
Yeah, I mean, certainly Chinese share classes can be very, very confusing. That you have A shares, which are the Shanghai and Shenzhen, really the market owned by investors in China. And then you have in Hong Kong, the H shares, which are comprised of red chips, which are more state-owned enterprises. The P chips, which tend to be more the private companies, non-government affiliated. And then you have things like N shares, which are the New York, NASDAQ. You have S shares, which are Singapore. So I think across all this confusion, the easiest way to think about China is really based on the investor base of these exchanges. So Shanghai and Shenzhen, 95% of stock ownership of those securities is by investors in China. The historical definition of China for foreign investors was Hong Kong companies. And in 2015, 2016, MSCI added US listed Chinese companies to that foreign definition. We then had the inclusion, which is still happening, this inclusion of these A shares, the Shanghai and Shenzhen names, into that foreign definition. And that's an inclusion that is still in the proverbial works, that they've started to add a large number of A shares, these Shanghai, Shenzhen names, but only a piece of their market cap. So only 20% of the potential weight of Shanghai, Shenzhen names, as defined by MSCI, have been added to this foreign definition. Now, the hard thing is you have these wide disparities in performance driven by these divergent views of domestic investors versus foreign investors' views of China today.
But there are also B shares, aren't there, historically? What's happening to B shares?
So B shares was a trial that China never pulls the proverbial Band-Aid. They always have a hypothesis, and they test it in a small way. And that way, if it goes well, you expand it. If you don't, you unwind it. And B shares were Chinese companies listed in the Shanghai Shenzhen market, but in a foreign currency, Hong Kong US dollar. It really didn't resonate with domestic Chinese investors. And we've seen the numeric count of B shares decline. So we think over the next several years, B shares will go away. We can contrast that with what we've seen in terms of foreign access into the Shanghai and Shenzhen market, where in 2001, they allowed the first foreign investors into that market. A decade of slowly providing more access to foreign investors, removing the restrictions on ownership and repatriation. They expanded that significantly in 2012, and they really opened up the gate in 2014, 2016 with the creation of the Stock Connect program. Stock Connect allows foreign investors access to Shanghai, Shenzhen names through the Hong Kong Stock Exchange. So really opened the door with Connect as opposed to the previous methodology of having to get quota and approval to invest in that market. So it shows really a divergent path of reform. B shares, the test didn't really work, but access for foreigners has really opened up very significantly over the last 20 years.
We know that if we dial in Chinese shares on the US market, we're getting exposure to the likes of Alibaba. It's a really high profile one, yes. Big IPO, of course. What about Western companies investing in China and listing in China? is that only done through Hong Kong?
So currently just Hong Kong, that you have companies, HSBC, Prada, you have a number of companies have chosen to list on the Hong Kong Stock Exchange because, in the case of, say, Prada, due to the love of luxury in not only China, but broader Asia. Obviously, HSBC was headquartered in Hong Kong before moving back here to London. So you have kind of companies that will kind of list based on where they think they'll get the best valuation. Also in Hong Kong, you have dual listed. You have Chinese companies like, say, BYD, the electric vehicle player, are listed in the mainland market, the Shanghai Shenzhen, but also in Hong Kong. And that was to serve a dual investor base, foreign demand, but also domestic Chinese demand.
And of course, Hong Kong has a historical connection to the West anyway, of course, I think it was 97, wasn't it, when it was handed back?
100%.
So there is a historical connection there. And of course, Hong Kong and Shanghai Bank, of course, as we now know, HSBC in London, of course, has very, very strong connections with Hong Kong. Do you think the time will come as we move deeper into a more meaningful relationship with the market in terms of operations and opportunities in China? Do you think China will ultimately open up the Shenzhen and the Shanghai exchange to overseas companies? Is that the long-term plan, do you think? Because China is moving, albeit at glacial speed, to try and engage with Western investors. That would seem to me to be a really good way to say to the West, look, we're opening it up.
Right. Yeah, I mean, certainly you've seen here in the United Kingdom, the Chinese government sell Chinese treasuries, and I think that will happen. I think you're 100% sure. I think that the opposite will happen, where you'll see companies say, like a Yum China is kind of interesting, where Yum split itself into its China operations versus its U.S. operations, and relisting on the Hong Kong Stock Exchange. So, over time, it certainly will gravitate to that mainland market because of that domestic Chinese investor base.
And again, from us here in the West, if we invest in that market, we're doing it through Hong Kong. So we're investing in what? Hong Kong dollars?
Correct. So that's one of the other way to think about it is obviously the Chinese companies listed in the U.S. like Alibaba are U.S. dollars. Companies like Tencent listed in Hong Kong are in Hong Kong dollars, and then Shanghai Shenzhen is renminbi, so the Chinese yuan.
Very quickly, what is the political appetite like at the moment in China for engaging with Western investors?
So it's some element of our bias, our optimism on China is driven at Kraneshares by we ply our wares in finance, where they really have opened up over the last 20 years. Now, I think finance is another test point of policymakers seeing what's happening in finance. So you've seen many global asset managers, many global banks, many global investment banks getting more and more access to the Chinese market directly without joint ventures. And you saw Tesla, the first foreign automaker allowed to operate in China without a JV. And so they're opening it up, and that will happen in automotive, it will happen in healthcare, it will happen in other industries. It'll just happen incrementally. That we're always in a big rush, but China tends to be very pragmatic, incremental in these reforms. They want to see how things go. And that's why it'll take time for, say, the automotive industry to get the same access as, say, the financial companies. But it'll happen. It'll just take time.
We look forward to seeing how things develop. But in the meantime, Brendan, thanks indeed for joining us.
Thank you, Jeremy.
For today's IG Trading the Markets podcast, that's Brendan Ahern from Kraneshares. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.